A rights issue is a way for a company to raise capital by offering new shares to its current shareholders, usually in proportion to how much they already own. These new shares are typically sold at a lower price than the current market value to encourage existing shareholders to participate. This helps them maintain their ownership percentage and control in the company. One key benefit of a rights issue is that it costs less to arrange compared to bringing in completely new shareholders through a public offering. Existing shareholders are generally more likely to support the deal as well. In this case, Company A's finance director has chosen a rights issue to secure long-term funding. To understand the company's financial position before this process, we can look at its balance sheet from December 2010, which shows fixed assets valued at £23 million, arrangement fees at £0.3 million, and current assets including cash, accounts receivable, stock, and other assets totaling £25.3 million. This financial snapshot sets the stage for the capital raising through the rights issue. Company A earned £17.6 million after tax, with 16.8 million ordinary shares currently issued, which gives earnings per share of £1.05. The market price per share is £3.26, but the finance director plans to raise £35 million through a rights issue. Rights issues typically offer shares at a discount to the current market price, so the company has decided to issue new shares at £3 each. This means issuing about 11.66 million new shares, or 0.69 new shares for every existing share held by shareholders. After the rights issue, the total number of shares will increase to 28.46 million, valued at £89.75 million, giving a new share price of £3.15. However, the market is likely to value these new shares at a higher price than £3.15 once trading begins. The stock market's confidence in Company A suggests it believes the company can invest the capital raised through the rights issue at a rate of return higher than the shareholders' required return. If not, confidence would be lower. Since stock market behavior isn't an exact science, it's important for the company to regularly reforecast its performance against market conditions after the rights issue. Looking at our example, the post-rights issue illustration shows a positive cash balance over the 10-year forecast period, with all lender credit ratios meeting their targets. Earnings per share grow steadily each year, which, when combined with the current price-to-earnings ratio, indicates potential share price growth. However, the company also needs to carefully consider its dividend policy since this influences share price growth, and we will cover this topic in a separate video. A rights issue allows existing shareholders to buy new shares at a discount, which helps the company raise capital while maintaining ownership structure. This strategy supports expansion or debt reduction without involving outside investors, which strengthens the company's balance sheet and builds shareholder confidence and loyalty. Ultimately, rights issues offer a cost-effective way to secure funding while preserving shareholder value. This approach offers an effective and fair way to raise capital because it keeps the interests of both the company and its current investors aligned. By giving existing shareholders the opportunity to buy new shares proportional to their holdings, it ensures that their ownership isn't diluted unfairly. It also signals confidence in the company's future prospects, as the capital raised can be invested to generate returns above what shareholders expect. This method supports shareholder value and helps maintain trust between investors and the company.